A very happy day to you and welcome to today's video on alpha versus beta. Continuing with our series of evaluation of a mutual fund, especially understanding fund performance, fund accounting, and for investors who are starting the investing journey of almost 2 to 3 decades right now. Okay, it's a good time to evaluate how funds work and how do you decide which mutual fund to invest in. Some of the parameters that we discussed in earlier videos, like we talked about the ratios that are spoken about, Sharpe ratio, covariance, standard deviation, etc., are presented in another video regarding how do we evaluate fund performance. So today's video, we're going to take a look at what is the meaning of alpha and beta, especially with reference to evaluation of a fund. All those Greeks, yes, these are Greek terms that are generally used for evaluation of fund performance. These include alpha, beta. Remember, we also, for those who know, we also talk about theta, decay in options, lambda for evaluation of option pricing, and so on. But this is with reference only to mutual fund evaluation, and therefore we'll stick to alpha and beta. Most of us never will look at an asset in isolation. There are thousands of assets available for us to invest in. Out of those thousands of assets, some of them suit us depending upon our temperament as well as the performance of the fund itself. Our mind, from the time we are growing up, is always evaluating performance versus somebody else's performance. So when we talk of running race, we think, oh, this person has come out first, right? And this the second runner up or the first runner up are the runner ups. So therefore, we never look at an asset in isolation. We are continuously evaluating because we have made sacrifices to save that money. And when we've made sacrifices to save that money and invest in assets, we want to pick a fund that has got good performance. All right. So therefore, investors never look at an asset in isolation. Very much comparison is needed, not only at the point of investing but also on an ongoing basis. Most of us make investments in mutual funds through SIPs. So therefore there is so many mutual funds in the country, all right, and to evaluate the performance of the mutual funds one versus the other, we need to have parameters of comparison. Investors also differ in their temperament. We have risk averse investors, investors who do not want to take risk. The risk averse investors are very happy with limited returns or predetermined returns. They don't want to pay, they don't want to participate in the risk return payoffs. We then have the risk seeking investors, investors who want to invest with an intention of getting higher returns. So the risk averse investor is more interested in principal protection rather than higher returns, whereas the risk seeker is an investor who looks for not just principal growth but also regular returns. So there is a variety of investors in the markets, and each investor has different attitudes, different philosophies, different temperaments. And therefore, if we have to evaluate a fund, we have to be able to understand ourselves first in terms of the risk parameter that we are in, and then decide which is the mutual fund that we are going to look at. Let's first take a look at beta. The beta ratio is a measure of volatility of the mutual fund portfolio vis-a-vis the benchmark. Every mutual fund is assessed and evaluated vis-a-vis the underlying benchmark. So when you're making an investment in mutual funds, the benchmark against which the performance of the fund will be measured has to be mentioned in the offer document at the time of announcing the NFO, as well as in the fund fact sheet. I've already explained in an earlier video about the fund fact sheet and what are the data that is contained in the fund fact sheet. The beta ratio is announced by the mutual fund on a monthly basis, and this explains the volatility of the fund vis-a-vis the underlying benchmark. If the beta is less than 1, it means the mutual fund portfolio is less volatile compared to the benchmark. For the whom is this suitable for? Is this suitable for the risk averse or the risk seeking investor? Remember, this is a measure of volatility. So, volatility is only showing the impact of the price movements, okay, vis-a-vis the benchmark. If beta is greater than 1, then it implies that the volatility is higher of that specific mutual fund compared to the benchmark. The more volatile an asset, generally speaking, it's more risky. Okay, that means the impact of the price movements is much higher on a stock which has got a beta that is greater than 1 than on a stock which has got a beta lesser than 1. So, in a bull market where the asset prices are increasing continuously day on day basis, the impact of price movements on a stock which has got a beta greater than 1 is much higher compared to the stock which or the portfolio which has got a beta that's less than 1. It's very rare to find mutual funds which have a beta exactly equal to 1, because that means the mutual fund portfolio is exactly mirroring the performance of the benchmark. This would, of course, be an ideal situation for a large category of investors who are risk neutral, because they are willing to take risk but not to the extent that asset volatility, price volatility diminishes the returns to the investor. Let's take an example. A company called XYZ Limited has a beta of 1.2 vis-a-vis the benchmark. So therefore, if the benchmark increases by 100 points, then the stock increases by 120 rupees. Okay, look at the impact of that. So this means the price movement is so high. This is really good during a bull market, but then this unfortunately is also very bad during a bear market when the prices are going down. This stock is very volatile, and if the beta of this portfolio is so high, then this stock implies that the investor is willing to play on the price volatility map. Another beta example. If you take a company which has got a beta of 0.8 vis-a-vis the benchmark, okay? If the benchmark decreases by 100 points, then the stock decreases by only 80 points. So this is the situation of the prices falling down. So when the prices are decreasing, a low beta stock will have lesser fall compared to a high beta stock, as opposed to the previous example where the high beta stock showed greater returns during a price increasing situation. So beta is only a measure of volatility. If you have the guts, if you have the what we call stomach, if you have guts of steel, as they say, then you should go for highly volatile assets. All right, which will give you great returns during bull markets, but it can completely eat away your principal can completely eat away not just the returns, but also the principal during a bear market. This stock is very, very stable, not as volatile as the benchmark. Let's take the second ratio, alpha. Alpha is a measure of performance. Okay, so beta is a measure of volatility, alpha is a measure of performance. So this directly shows the fund manager's performance, the fund manager's ability to outgrow the portfolio's returns. It helps investor identify the best performing investment funds. It shows the outperformance of the portfolio versus the benchmark. So this is a direct evaluation of the not just the fund house, it's an evaluation of the fund manager, the asset allocation strategies, the portfolio management selection. Everything is determined by this one parameter called the alpha. So how do we evaluate alpha? If alpha is positive, it ranges from -1 to +1. If alpha is positive, then the fund is an outperformer, and everybody wants to invest more and more into funds that have high or positive alpha. Okay, because you have conviction, you have belief that the fund has outperformed itself. Why would anybody buy a bad asset? You'd obviously want to buy a well-performing mutual fund. If alpha is negative, then the fund is an underperformer. This will result into significant redemptions. Investors want to remove their assets from mutual funds which have a negative alpha. They will put it into an asset, into a mutual fund that has got a positive alpha. So negative alpha is not good for the mutual fund investor. And if of course alpha is zero, then fund returns are identical to the benchmark returns. In the case of index funds, the fund manager has exactly duplicated the index fund, and therefore the alpha could be zero. So we have to be able to read both alpha as well as beta in sync with each other if you want to be able to evaluate which fund you would like to invest in. What is good for you? If investor is risk averse, then you must select an asset which has got a low beta because you don't want to play on the price volatility game. It is a difficult game, it's a challenging game. It's a game which is meant only for investors who are able to shoot darts in the dark with perfection. Then you look at stocks beta. If the investor wants to invest in high performing funds, then you look at the mutual funds alpha because that measures how much fund can be used as a parameter for evaluation. So my suggestion is always when you're starting off your investing journey, look at the fund fact sheet, look at the alpha beta because all of these are extremely strong indicators of mutual fund performance. But remember, alpha and beta are both past performance indicators and do not give you any signal of or are not any indicator of future performance. Thank you so much for watching this channel and hoping to see you all again for the next video. Thank you.